Croeso, welcome to the Aberystwyth Business School Level 3 Business Lecture Series. Today I'm going to look at setting financial objectives and focusing in particular on the cash flow and the cash flow statement. This content is to support the Level 3 business. So today, the learning outcomes for this little lecture series is the understanding of financial objectives, the value of setting financial objectives for an organisation and its stakeholders, the distinction between cash flow and profit, the objectives of cash flow, the cash flow statement as part of the financial statements, and the cash flow forecast. So the first question is, what is a financial objective? Well, a company should set both financial and non-financial objectives to form part of the financial planning process of a business. They can act as a target of the business that can be expressed in a monetary term within a set timescale. Financial objectives are different from other types of objectives, but should work closely alongside them. So the value of setting financial objectives for a company and stakeholders are that it acts as a focus for senior management and departments of a business to concentrate on what they want to achieve. It can be a very valuable measurement tool. You can measure it against previous years to see how you're doing, targets that you may have set in your annual plans, or to measure against competitors. Financial objectives can improve coordination and efficiency within the organisation and between departments. The company's shareholders and other stakeholders are also able to assess the financial viability of the company based on its financial objectives. They can also be used to identify and reduce risks, to try and mitigate or reduce them. It can anticipate future challenges and threats and ensure that resources are available to deal with them. It gives the organisation greater control over its budget and provides valuable data to aid decision making. They also enable a business to grow and increase its market share over time. So examples of financial objectives could include increasing its annual revenue by, let's say, 10% per annum or 20% per annum, achieve a profit margin of 20% by 2021, reduce the current stock levels by a monetary amount or by a certain percentage by a set period of time, have the objective to maintain a positive cash flow or to reduce expenses from the cash flow, explore and exploit new markets to increase sales, which in turn will increase the cash, purchase new fixed assets to increase efficiency and reduce overhead costs. So, for example, a book publisher might look at a new printing press, which can produce faster print runs more effectively and cheaper, or reduce the level of debt. So when we talk about cash flow, cash and profit are related, but they are not the same. Cash is an asset to a business, and we often see it in the balance sheet under the current assets. And it can be measured at a particular point in time, usually at the end of the financial year. But profit can only be earned and measured over time. The difference between them depends on the sources of the cash transactions and the basis of accounting. So, for example, in the cash flow, we would not be including accruals or prepayment adjustments or depreciation costs, which would be included in the profit figure in the profit and loss account. So when we're looking at the cash flow statement, the cash flow statement is part of the financial statements alongside the profit and loss account and the balance sheet. It is a summary of the amount of cash coming in and out of the company at the end of the financial year. It measures how efficient a company is in managing its cash position. It identifies how well a business generates cash to fund its operating expenses and debt obligations. Cash is often referred to as cash is king. Without good cash flow, a company can often cease to work. So the cash flow statement is made up of three parts. Firstly, the revenue or income. This is often seen as sales. The second, the expenses or outgoings. So these could include salaries, admin expenses, rent, rates, etc. And the balances. So we'd have an opening balance for the start of the period and a closing period at the end. So like I said, with the revenue, it's income received by a business for goods or services provided. This revenue is often split into cash sales and debtor payments, so a company can analyse it more effectively. The expenses is all the money spent by a business within the time period, and is shown here. Expenses are broken down within the cash flow to see where the money being spent, and this analysis can often aid ways of saving money and looking at the expenses individually. So examples of expenses could include wages, electricity, rent and stationery. So when we discuss net cash flow is simply the total revenue less the total expenses. If the revenue is more than the expenses, the cash flow would be seen as positive. We've got money left over after paying all our expenses. If the revenue, the income, is less than the expenses, so if our incoming is less than our outgoing, the cash flow would be negative. Okay? So if revenue is more than expenses, we've got more than enough money to cover our costs, so we'd have cash left over. If we don't have enough revenue to cover our expenses, we go into negative cash flow, often seen as an overdraft on the bank statement. So the closing balances. The closing balance at the end of each period is simply that each period has an opening balance that has been carried forward from the previous period. And this opening balance represents the amount of cash available at the beginning of that period. The net cash flow, so the income less expenses, is added or deducted from this figure to form the closing balance. So we start with the opening balance, we adjust it for our revenue and expenses, and we are left with a closing balance. How much cash is left at the end of that period? So for example, let's say that we've got a cash flow statement for 1 month, and that month being January. So we've made 1,200 in sales. Our total revenue is 1,200. But our expenses for that month are considerably higher. We've incurred costs of 4,900. So the revenue, less the expenses, leaves us with a negative cash flow of 3,700. So we've gone into overdraft that month of 3,700. Okay. So as you can see, this is not a good position for a company to be in, and they'd have to be mindful that this pattern isn't repeated over a number of consecutive months. So let's take the cash flow statement for the 3 months beginning January. We know from the other slide that we had 3,700. Okay, I'll just skip back to the previous slide so you can see where it came from. Okay, so it's that final figure, that last figure there, the net cash flow, 3,700. So that closing balance in January becomes our opening balance in February. So it moves to the top of February. So we're starting February in a negative position of 3,700. We then incur revenue and costs, which total a negative 1,660. So we've spent £1,660 more than we could afford in that month. So that leaves us then with an even more negative closing balance in February of 5,360. Okay, so that 5,360, the closing balance of February, then becomes the opening balance in March. So March now has an opening balance of 5,360 negative. We then see that the net cash flow in March, the revenue less expenses, is negative 700. So expenses have exceeded revenue by £700 in March. This leaves us with a closing balance of negative £6,060 in March. This means that we've been overdrawn for 3 consecutive months. Using the cash flow statement to analyse the costs, the companies should be looking at ways of saving costs for these 3 months, because the pattern is showing that the company is going further overdrawn over time. So just to recap, the cash flow statement forms parts of the financial statement and is a historic document like the profit and loss and the balance sheet. The cash flow statements are also used to forecast future periods, investments or particular scenarios. Managers and accountants can use the historic information presented in the cash flow to try and forecast future events, the future periods, using that information, along with the knowledge they have of the future developments. So companies often forecast a cash flow statement for the period ahead. They use it as a budgetary tool. So the cash flow statement is used to predict the likely flows of cash into and out of the period ahead. The accountant or the manager based this forecast on past experience. So they're looking at historical actual cash flows to look for trends or to look for certain patterns. They look ahead at current and expected future and economic and financial trends, and their knowledge and understanding of the business. So a business actual cash flow statement can often differ considerably from its cash flow forecast. So the company would have prepared a cash flow forecast before the beginning of the period and would hopefully compare their forecast at the end of the accounting period with the actual cash flow statement to look at the differences and to see if they can budget, if they can forecast more effectively in the future. But what are the reasons for the differences between what the business forecasted and its actual cash flow? Well, accountants and managers cannot predict the future. Okay? There are a number of changes during the accounting period during the year. For example, the economic climate could be quite turbulent. They can't predict what will happen during the 12 months. There can be a number of political changes. Technology advancements or issues might hinder or make cash flow better. There might be new competitors being particularly competitive with their prices, with their retail prices, which may then affect your sales. Finance, you may find that interest charges on loans may increase considerably more than you expected. And fashions, your product may well have been in vogue when you did the forecast, but may well have fallen out of fashion. seeing a considerable drop in sales to what you expected. So the cash flow forecast is used as a good guide for a company to try and manage its cash flow. But the person producing the forecasted cash flow cannot predict the future totally. So, typical reasons for issues within the cash flow forecast. The actual sales may differ from the expected level. Costs may increase. For example, oil prices fluctuate and they may increase considerably, affecting your cash flow. Internal factors. You may have had a change in staff, which affects the staff expenses, the wages, or inadequate or poor quality information. So you may have a manager that's new. You may have departments that won't share information, so that quality is not right. Maybe the accounts clerk has entered data into the database incorrectly, which means the data that you are using is incorrect. So using the cash flow effectively. All businesses should monitor cash flow regularly to keep on top of it and look for any issues. Any deviances between the actual and the forecast figures should be examined and raised with the relevant department or manager. With experience, the accuracy of forecasting should improve, and the forecast should tell a business if they have sufficient funds to pay future expenses. So if a company finds themselves in a negative cash flow for a long period of time, there is ways of trying to mitigate these issues. The obvious one is trying to increase revenue. So going out and trying to increase either sales volume or, if the market allows, the sales price of your product or service. The different cost headings could be analysed and looked at to see if we could reduce costs in any of these headings. For example, maybe reduce staff costs, move to a cheaper premises to cut down on rent, become more energy efficient with electricity. Delay payments. So if you find that the cash flow is negative in a couple of months, you may well be able to negotiate to delay a payment to a month where the incoming cash is more than in the months that you're looking at. You could try and get additional funding, either through grants, through a parent company, or through loans, or invoice factoring, where you sell your debts to a company and they reclaim them, but you get the money nearly immediately. So the objectives of a cash flow are to evaluate a company's cash position, ensure future positive cash flow by making sure that cash payments and incomes are evenly spread through the year if possible, that the company is able to pay any dividends effectively. It gives a good picture of the liquidity position of the company. You can use it to compare with previous years to see how the company is doing, and it provides a much greater detail and clarity for any areas of concern that the business may have. So examples of cash flow objectives can and may include reducing bank borrowings and overdraft to a targeted level, reduce the average debtor day ratio, so if needed, trying to chase your debtors for earlier payments so the cash is received quicker and can help your cash situation. Increase average creditor days ratio effectively, so seeing if you can effectively delay when you pay your creditors. Develop a rainy day fund, so you've got some cash that you can exploit, that you can draw on should anything unexpected take place. Another objective of the cash flow is to stabilise the cash flow and reduce peaks and troughs during the period. So while cash flow forecasting is positive and needs to be done, there are some limitations of using cash flow forecast. Doing a cash flow forecast can be extremely time consuming to prepare and monitor. To have a valuable cash flow forecast, it must be accurate, and that means that the data going into the cash flow needs to be up to date and correct. The longer the time frame, so say if you're producing a cash flow forecast for 12, 18 or 24 months, then more than probably going to be less accurate the cash flow forecast will be. The rate of inflation can often not be predicted and can impact the figures. And not all information within an organisation may be shared with a person producing the cash flow forecast. So thank you for listening to my lecture on financial objectives and the cash flow. Prepared a couple of activities for you to do. We've got 4 questions based and extracted from the Edexcel Winter 2010 paper and a short multiple choice question sample sheet. Thank you very much for listening. Thank you.